Back in April, Trade Liberation Day saw stock markets plunge around the world. It made front-page news, and in a partial U-turn, some tariffs were paused. But over the next few weeks and months, the stock market has pretty much recouped all their past losses and in fact reached record new levels. Yet, the average tariff rate continues to be at the highest rate since the 1930s. When Trump announced a new wave of tariffs at the end of July, stocks fell a little bit, but in truth, barely moved. Despite all the turmoil and uncertainty, US stock price to earning ratios are at the highest level since the dot-com bubble. Yet, while stocks reach record levels, the bond market takes a very different view. Yields have been rising sharply, even as the dollar has been in persistent decline. Treasury bond futures continue to slide, indicating the bond market is really quite pessimistic. It's not just that tariffs are reaching the highest rates since the Great Depression, but trade and economic global uncertainty is reaching unprecedented levels. The global economy faces many uncertainties, not least geopolitical conflict and the radical new direction of US economic and foreign policy. Now, on the surface, it may seem that tariffs had little effect on inflation and GDP, at least in the short run, perhaps a case of economists' worst-case forecasts proving wide of a mark. But to declare tariffs are winning for the US economy would be a mistake. Their introduction has been relatively recent, and so far firms have tried to avoid passing the higher input costs onto consumers. This was partly achieved through stockpiling started at the beginning of the year. Yet, as these tariffs gain a greater sense of permanence, firms will no longer be able to avoid passing on the cost of these higher tariffs. And these higher input costs are something that US business are really starting to notice, be it a knife manufacturer in Montana, US farmers, or US car giants like Ford or General Motors. Ford complained that with tariff rates on inputs of 25%, they are now at a competitive disadvantage to Korean and Japanese car firms who have a 15% tariff rate. According to the Wall Street Journal, Ford and GM have been paying $800 million and $1.1 billion in tariff costs in the second quarter alone. Worth bearing in mind that despite these higher input costs, GM haven't increased prices yet. But it would be a mistake to feel that tariffs alone are going to cause an economic crash or even economic recession. Yale Budget Lab predict that the current tariff rate will reduce GDP by 0.4%. That's not something to get particularly excited about. Imports are only 14% of the US economy, much smaller than for other countries. But there are a few other factors to bear in mind. Firstly, the impact of tariffs will be much greater on consumers and households. It could raise prices by 2%, an extra $2,000 on the household budget. Whilst corporate America can generally brush off tariffs, lower-income households will face the biggest cost. If you want to understand the US economy, it's really a two-speed economy. Corporate profitability is rising, reaching record levels, and you could argue it's hard to have a recession when companies are so profitable. Households, though, spend an ever greater share of their income on necessities such as food, utilities, insurance, housing, and medical costs, all been rising in recent decades, which combined with stagnant median wages, no wonder many American consumers feel worse off. But corporate America is still pretty bullish, and there are reasons from their perspective. Corporate profitability is still high and growing, especially amongst tech stocks, who are not really affected by things like tariffs on steel. Meta and Microsoft both reported higher than expected growth in profit, and the big tech firms are benefiting the most from artificial intelligence, with Microsoft saying they're cutting back on hiring workers as they make greater use of AI. Sam Altman, pioneer of AI, claims that the day of a 1 billion firm with just one person is only just around the corner. Another big development is the S&P's 10 biggest companies are growing at a much faster rate than the other 490. Tech stocks are now priced at 2.2 times higher than the S&P 500. That is the highest ratio since the dot-com bubble of 2000. Yet, whilst banking and tech are doing really well, other sectors of the economy are not. The farming sector is in near crisis due to the trade war, declining export demand, higher input costs, and low commodity prices. Plus, of course, a crackdown on immigrant labour. As one US farmer recently noted, if we drive away the illegal immigrants, who is going to do the hard work in 100 degrees heat and poor working conditions? Also, after the negative growth in the first quarter, GDP figures did actually bounce back with an annualized rate of 3%. That's hardly an economic crash. Though it is worth pointing out, growth in the first half of 2025 is just 1.1%, almost half the rate of the last half of 2024 at 2.2%. In relative terms, US economic growth has been marked down the most out of other advanced economies. Also, if you take away the big tech stocks, the stock market is actually not that particularly impressive. Secondly, the recently revised jobs report was well under expectations, with jobs created much less than expected. It also showed a rise in unemployment. One of the few sectors to create jobs in significant numbers was healthcare. But the more cyclical sectors are showing a stagnation in jobs, and there's been a rise in the number of people expecting a deterioration in job prospects in the next 6 months. And historically, this is often a reliable precursor to recession. Ironically, the declining employment prospects do raise the prospect of lower interest rates, though it's not clear that, given the uncertainty in rising prices, lower interest rates will be a panacea for strong economic growth. Now, if it was just tariffs, the US economy's strong fundamentals could pretty much shake it off. But there are other factors weighing down the US economy. Firstly, the housing market is weighed down by record high unaffordability. Homeowners locked into 30-year mortgages but unable to renew at much higher mortgage rates. Renting's a bit of a nightmare too. And for first-time buyers looking to buy, the market is still pretty much a nightmare, with house price to earning ratios pretty much near record levels. And as a result of new buyers being squeezed, nearly 1/3 of cities now show falling house prices. And given the importance of housing wealth, any kind of house price falls would be a major blow to household confidence and wealth. By the way, whilst we worry about tariffs causing a 0.4% loss of GDP, studies suggest that excessive restrictive zoning is costing around 2% of GDP. Now, the dichotomy between the stock market and the bond market is definitely interesting, because since the start of the year, bonds have been sold off, causing higher yields. And this reflects a number of factors: the continued deterioration in US public finances. There's a concern it's getting to the point of no return, where debt just continues to rise and politicians are incapable of dealing with it. The recent Big Beautiful Bill caused even higher levels of borrowing, and that's assuming the economy continues to grow. And this will see debt rise at an unprecedented trajectory over the coming years, primarily because of ageing population, high demand for healthcare, but also because of the fiscal policy of recent governments. Also, financial markets are also adjusting to a new reality. There are fears over Fed neutrality, with President Trump wanting to replace Fed Chair Jerome Powell. Also, it was unprecedented to fire the BLS chief after moderately disappointing Labour data. There are also concerns about the long-term strength of the US economy. Traditionally, its strengths have come from strong academic and research sector, stable and safe institutions, a global economic and political leader with a global reserve currency. But the turmoil of 2025 has thrown all these up in the air. No one's quite sure how they will land. Now, at the moment, the stock market is booming, helped by rapid growth in the M2 money supply and undoubted levels of wealth that has accumulated in recent years. At least amongst the top 50, top 20%, wealth has increased a lot in recent decades. Though, if you are a pessimist, it is worth pointing out a lot of these wealth gains come from a booming stock market itself and perhaps overvalued real estate. Now, whilst it is tempting to think that erratic trade policy will cause a global crash, the US economy still does retain certain strengths. Household debt to GDP is relatively low compared to the credit crunch, and household debt service payments as a share of disposable personal income are also relatively low. But if the economy does slow down as expected, things could definitely change. So a lot of headwinds facing the US and global economy. It's going to be interesting next few months, so do subscribe and we'll keep you updated. Thanks for watching and have a great day.